Good morning, guys. It's Jeff, Mike's partner. Mike's actually on spring break this week, so he asked me to fill in for him today, and so I'll be covering the topic, and he'll be back first part of next week, but we're still open. If you have questions or if you need anything, absolutely feel free to email or call in, and we're happy to help you. I know Mike likes to open it up for questions to begin, so I'll take any questions. And also, for today's topic, we're going to be talking about the disclosure meeting, and we're going to be talking about titling. So, a couple of things. First, if I could get a volunteer to kind of help me in role play and bounce things off of, that would be great. And second, it might help if you went to the website, looked under the disclosure meeting, and clicked on the titling script so you could follow along as we're doing that. So go to the website, click on the disclosure meeting, open up the titling script. I think that'll be helpful for you to follow along. And if there is somebody that would volunteer to kind of role play with me and be my sounding board, that would be great as well. Like Mike always says, I think the person who does that always gets the most out of it. But before we get to that, any questions that you guys might have to maybe start?
Jeff, I have a couple of questions. First of all, Don O'Connor has been willing to volunteer, so
Okay, great.
he's got an open line. Don, can you hear us okay? Okay, well maybe he's working on his microphone. So Don, can you
not a problem.
try to work on a mic there?
We have a couple of things to cover before then anyway, but...
Perfect. And then Rick Kirk actually just got done with his first couple of seminars, and he has a couple of questions that I'm working on typing in the answers to, but maybe it's just easier to answer. So he says he completed his first 2 workshops on Thursday last week. He's looking for the letter to send to no-shows and cancellations. Is there one? Also, which letter do I start with for the attendees that did not book appointments? So the answer is, there is no letter to send to the no-shows and cancellations. If you were able to get their email at the time that they registered for the event, then you'd be able to put them on your drip. But otherwise, you're just going to keep hitting them with future mailing pieces somewhere down the road. There is no specific letter that you would find for no-shows or cancellations.
Yeah, as far as a letter for no-shows and cancellations, I think the reason that we don't have a letter like that is I'm not sure that it would do a whole lot of good, because remember, they didn't come, which means they don't know you. So any letter that you would get would seem like it's out of the blue. I think it's fine if you have their email to send them the seminar follow-up, the Clients IQ drip that goes out afterwards, because I think being that it was last week, it might be fresh on their mind. So if you have their email address, I would start them on that. If you don't have their email address, but you have their mailing address, I would probably go ahead and put them on the prospect drip, because there's a hard newsletter that goes out every once in a while. But beyond that, I don't think there's anything that I would do for people who didn't show or who canceled. People who came and didn't make appointments, you'll start them on the seminar drip.
Okay. And we do have Don's phone line open here now. So, and Mickey does say if they use TeleDirect, there are letters posted there. Okay, well there you go. I guess I wasn't aware of that. So Mickey knows of some letters on TeleDirect. That would be the RSVP service. They must have some letters posted there. So I'll have to go out and take a look at that. But Rick, that's also something you can look at.
And here's actually, I'm glad Rick's on the line. It doesn't sound like he has an open phone line or an open connection, but, before we kind of get started, what is consensus? Guys, it's the idea that people look to others when making a decision, and we do it all the time. If we're sitting in a movie theater and we're not sure where the exit is, what do? We look around to see where are other people headed after the movie. We just assume they're headed towards the exit, so we just follow along. We're always looking to other people to validate any decision that we might make. So here's the thing. Can you get consensus from a newspaper ad? And the answer is no. I mean, when you're just sitting there paging through the newspaper and you see an ad, there's no one that you're going to look to. There's no one else around to see what they're doing, to see if they're calling, to see if they're reacting, to see what their opinion is of the ad. Same thing with the lead card. It comes to your house, you look at it alone, and you make your decision by yourself. You're not really looking to anyone. You can't get consensus from an internet lead. So all forms of marketing, it's very difficult to get consensus from, whether it's a newspaper ad or a lead card or an internet lead. But there is one form of marketing where you can leverage consensus, and that is a group event. And here's the thing about consensus. It's always at work in any kind of group. And let me say that again because I think it's important for us to understand that consensus is always at work in any kind of group, either good or bad. So here's the thing. Consensus is always happening if you're in a group. So if we're doing a group presentation, consensus is happening whether we like it or not. And so if no one answers any questions, or no one acts or makes appointments, how does that affect someone who's thinking about acting or making an appointment? Well, it gets them thinking, well, if no one else is answering and no one else is lining up to make an appointment, maybe, you know, it's premature for me to do that. Consensus can work against you. But if everyone is answering and everyone is acting or everyone is making an appointment, doesn't that make someone who's not doing those things think twice? Makes them think, well, maybe I should be participating. Maybe I should look to get an appointment. If everybody else is doing it, maybe it is a good idea. And so we had 2 people do presentations last week. We had Rick Kirk do a presentation last week, and we had Steve Sumas do a presentation last week, and these were their results. They were kind enough to email, and Rick, I'm not sure if you can open his line or not, but he emailed and said that during his first presentation, people were laughing, people were participating, people were lined up to make appointments. So he had 26 people show up for his very first night of the event, and he got 9 appointments. So we might be looking at 13, 14 buying units and 9 appointments. So that's great. That's well over 50%. And then we also had Steve say that he had 23 people show up. And I'm not quite sure how many buying units that translates to, but he said that he got 42% appointments. And Missy, what did Steve say happened during his presentation?
Steve had all sorts of issues. The projector didn't connect to his computer. He then, when he finally got that all fixed, so they ended up starting late. Then he got about a fourth of the way through it, and his computer aborted with the blue screen of death, and so he had no visuals for the dating game and no visuals for the dots or the coin toss or no gorilla video and no card game visual. But he said facility was great, the food was wonderful. Overall, everyone liked his presentation, and he got fabulous statistics. Jeff, you want to go ahead and share those, or?
Yeah, we had, like Steve, he had the 23 people and the 42% appointments, so he did great. And it sounds like almost everything that could have gone wrong did go wrong. But the one thing that both of them said is they had everybody laughing and participating. And the great thing about this presentation is you get people coming because it is different, and it does give you an opportunity to interact with people. And if you do that, you build a lot of consensus and you build a lot of goodwill, even if your computer doesn't work, even if you can't show all the videos, even if you can't show all the slides. So make sure you're out there having fun, getting people to participate, getting people to interact, because I can tell you that the guys that have done it, even last week, had great, tremendous success with it. So it's an ideal presentation for that. Make sure you're out there doing it. And we have a lot of, we get a lot of emails like that from people who finish their events saying, you know what, I had a lot of people show up, they had a lot of fun, I got a lot of appointments, so this is the best time to be out there marketing. It's a great time to be out there, and we have feedback from your peers that it's working, and leverage that consensus. A group presentation is the only way that you're going to get that. So I know Mike likes to start off with a pointer, so I'm going to start off with a pointer too. But before I do that, any questions about any of that?
And Jeff, just to add one more thing, we did have more than just those 2 seminars. I know Patrick's not on, but he actually had the fabulous response. So he had 99 RSVPs actually show up for his seminar last week. I don't have a ton of feedback back on his. Mike actually has been talking with him, so I guess I'm not sure exactly what was going on. But we did have more than those 2 seminars, so I just wanted to make you aware of that too. So.
Yeah, and we don't always hear from people, but we did hear from Steve, we did hear from Patrick, we did hear from Rick, and all the feedback has been really great. So get out there and do that, and have confidence that it works, that people like it, and people do find it interesting and entertaining, and they do make appointments as a result. Because it would be one thing if they found it interesting and entertaining, but nobody came in to see you afterwards. But here we have something that's interesting and entertaining, and people are lining up to come and see you afterwards. So if you haven't done one, certainly get started and get that scheduled.
And Jeff, I just unmuted both Rick and Don, so Rick's on the phone there too.
Okay, and Rick, what would you have to say about your experience with the presentation that you did?
The presentation went great. I had trouble with my computer the day that I was going to do it this drive with. So I had to load everything up on my wife's computer, but we were able to get it done. I mean, it was fun.
Good.
Yeah, it was compared to standing in front of the group like a lecturer and not taking questions, which is what I'd been taught to do in the past. Because questions, they say you don't take questions because they're not pertaining to the next guy. This was fun. I mean, people were laughing. They were having a good time. The dot game, the card game, it was really neat. And people were sitting when it was over and they were done with their meal. They were sitting waiting for me to get to them to book an appointment. I mean, I've never seen like it.
Good. Okay, so here's the pointer for today. How do you get an engineer? Because here's a question. Are engineers easy or hard to get? Most people tell me they're really hard to get. And so we ask ourselves, well, why? What's different about them? Why are they so hard? And Don, you're on, right?
Yes, I am, Jeff.
Why would you say, do you like engineers as clients or as prospects?
Not particularly, but I have a few clients who are really good clients who are engineers. I mean, they tend to be nitpickers. They want to look at all the fine details. They're not generalists, certainly.
Right. They're nitpickers, right? They're skeptical. And when they're nitpicking, are they looking for all the reasons to do something or all the reasons not to do something?
Not to do something.
Right. So they're, like Don said, they're nitpickers. They're gleaning through everything that you show them, gleaning through everything that you tell them, looking things up for themselves and trying to figure out, are there weak spots? Are there reasons that I shouldn't be doing these things? So here's a question. What can we show them that doesn't have any weak spots? What investments can we show them that doesn't have any weak spots? How about stocks? Do stocks have any weak spots?
Sure they do.
Bonds? Do bonds have weak spots? Variable annuities? Do variable annuities have weak spots? How about fixed annuities, indexed annuities? Do they have weak
Everything
spots?
does. There's no silver bullet. Everything has pros and cons.
Right. So here's the thing. Everything, anything that we would show them would have a weak spot. So we can't come up with a list of things that don't have weak spots. We can't even come up with a list of one thing that doesn't have a weak spot. Cash has a weak spot. CDs have a weak spot. You know, cash and CDs don't pay anything, so they don't keep up with inflation. That's their weak spot. But everything has a weak spot. So if we can't come up with things that don't have weak spots, then guess what? We can't bring on engineers. Not only can we not bring on engineers, we can't even bring on people that are skeptical and looking for weak spots. And here's a newsflash for you guys. Everybody's an engineer. Not to the extent that engineers are. Not everybody's pouring through everything and nitpicking. But most everybody that we're going to run into, are they skeptical?
Sure.
And are they looking for reasons to do things, or generally looking for reasons not to do things?
They're afraid not to do things.
Yeah, they're afraid. So it's easier sometimes to do nothing, which is why it's often hard to bring on clients. Because like engineers, they're skeptical and they're afraid of making a mistake. They're looking for the weak spot. And like we just talked about, we don't have anything that doesn't have a weak spot, so we can't bring on engineers or skeptical people. But Don, you said you've brought some on before, right?
Of course.
So it's not impossible. What we need to do to bring these kinds of people on is we need to change the conversation. It can't be about an investment that doesn't have any weak spots, because like we said, there's no such thing. What it has to be about is choosing the thing with the least weak spots. Choosing the thing that has weak spots, but fewer weak spots than anything else you might do. Finding the thing with the least amount of weak spots for you. And in order to change that conversation into what can I invest in that doesn't have weak spots, to what's the thing that I can do that's best for me that has the fewest weak spots, you have to compare your solution to other solutions. And this is the mistake that I see guys make in the field all the time. They have a great meeting with the client, and they feel like they're really connecting and they're on board and the client's on board with everything that they're saying, but when it comes time to show a solution, they only show one thing, which is, let's just say, for example, it's the indexed annuity. And even if the client likes it, what are they likely to wonder?
Is there something better out there?
Yep. And if they're wondering that, what will they do?
They won't do anything.
Yep. Or they might do one thing, which is shop.
Sure, yeah. But they won't buy at that point in time.
They won't buy at that point because they're not sure it's the best thing. They'll be tempted to go and look it up, ask their neighbor, ask their current advisor, ask their friends, hey, what do you think about this? And again, are they going to find reasons to do things or reasons not to do things?
Not to.
And instinctively we know that. We know when a client leaves and says, well, you've given us a lot to think about, let us go back and kind of mull it over and get back to you. We kind of know the chances of us getting that person as a client have gone way, way down.
Yeah.
So if you want to bring on that kind of person, what you have to do is show them more than one solution so that they can compare and see for themselves all the things that are out there and choose the thing with the least weak spots. And here's what I found. The more skeptical the person, the more comparisons you have to give them. So if it's just your general person who has an advisor and is looking for something a little bit better, and you have a great agreement meeting and a great disclosure meeting, well, they're going to leave anyway. But they're going to feel really good about the solution if you not only show them one thing, but you compare that preferred solution to other things and show them how your preferred solution has fewer weak spots than the other things that they could look at. The more skeptical the person, the more comparisons you have to give them. So let's talk for a minute. What are some things that are out there that we could compare an annuity to? So let's say people say, well, we want some of our money for growth, so that's going to be our growth money we're going to put in, say, managed money or the stock market or mutual funds or whatever the preferred solution for growth money is. But we want something, we don't want all our money in the market. Why would people, particularly in the age range that we work with, not want all of their money in the market?
Because of the risk factor downside.
Right. Because if you have all your money in the market, it could all go up, but it could also all do what?
Go down.
Go down. And the one thing that the clients that we work with don't have is time. See, if you're working with a 20 or a 30-year-old and their whole portfolio goes down, they have a couple things going for them. First, they're 20 or they're 30, so they have a lot of time to recover. Second, they have a job. So hopefully they're not living off their investments, they're living off their paycheck. But the people that we work with oftentimes don't have jobs. They're counting on that portfolio for income. And second of all, they're pressed for time. They don't necessarily have 10 or 15 years for things to bounce back and recover. So they're looking for something safe for their safe money. They understand that they still might live a while and they need to stay ahead of inflation, so they'll put some money in growth, but they also want some of their money safe. And so if we're thinking of an indexed annuity for safety, what are some other things that are out there that are safe that people might consider?
Well, people would consider bonds, certainly.
Yep, people would consider bonds, but what's the problem with bonds?
Well, interest rate is so low right now. Not only aren't they going to get a lot of interest, but if they have to sell before the bond matures, if interest rates go up, they'll still lose a lot of money, even though they're not usually aware of that.
Yeah. Individual bonds would be one thing you could compare it to. The problem with bonds, and there's a whole discussion about this bonds in the disclosure meeting that people can go back and look to, is that interest rates can go up, and as interest rates go up, bond values go down. And there's a whole, we could walk people through and get them to tell us why that happens so that it's not just us saying it. They know why it happens, and they could explain why it happens. In fact, I've read, and you can see when we go through our discussion on bonds, but I've read recently that if interest rates were to go up by a point or two, that we could expect a 20% drop in bond values. And we could see that happen over the next 18 to 24 months. And when we're talking about safety, what other kinds of investments do you know of could lose 20% of their value in a year, year and a half?
Stocks.
So in that sense, bonds really aren't any more safe than stocks. Now, individual bonds do have a measure of safety built in that you can hold them to maturity.
Mm-hmm.
But to get any kind of yield on a bond these days, how far out do you have to go?
Got to be long-term, 5-10 years or more.
Yeah. And what are the likelihood that interest rates are going to go up anytime in the next 10 years?
Very high.
Very high. That, and one of the things that people overlook when it comes to bonds is the QE1 and the QE2 that the Fed did, a program where they bought bonds. It's supply and demand. So when the Fed is buying a bunch, hundreds of billions of dollars worth of bonds, what do you think happens to the value of bonds as they're buying and buying and buying? They go up.
Well, they go up because they're buying a lot, yeah. But of course,
so
when
in
they
the last
start to
couple of
sell a
years,
lot,
you may have a client that comes in and tells you my bonds have actually done pretty well, which they have because interest rates have been low and the Fed's been buying bonds. But going forward, we know that interest rates are likely to go up. We don't know when, but we know that it's eventually going to happen. And the Fed, their intent was never to sit on those bonds and just hoard them. Eventually, at some point, when they feel it's appropriate, what are they going to do with those bonds?
sell them off.
Yep. So what happens when the Fed decides this is the day we're going to sell $600 billion worth of bonds?
Price is going down.
Right. So bonds, that's not where the smart money is these days. Smart money is not going into bonds because why?
Because of the things you just said, because of the risks inherent in holding them. Although more people are buying junk bonds, but they're just increasing their own risk, just trying to get a return.
Yep. Well, you could look at safe bonds, or you could look at corporate high-yield bonds, which have credit risk. So that's the other risk with bonds. Interest rates going up, the Fed, supply and demand, releasing or selling back all the bonds that they bought. And then you have credit risk. Companies that don't have good credit, so they have to offer a higher yield or a higher interest rate to get people to invest in them. Because they can't go to a bank. A bank won't invest in them. So is that the kind of thing that our clients would want to invest in, something that the bank wouldn't even invest in?
Not if they understood that, no.
No. So bonds are something, but again, They have a lot of problems that annuities don't have. What else is out there that people could invest in for their safe money besides bonds? We don't like bonds because they have a lot of problem. What else is there?
Well, a lot of people talk about preferred stock.
Preferred stock, but that works just like a bond.
Yes,
The only
it does.
difference between preferred stock and a bond is preferred stock is a little bit riskier in the sense that it can go down in value, like a bond fund, and you don't hold it to maturity. There's also cash and CDs, right?
Yep, sure.
But what are the problems with those?
Well, you're not going to keep up with inflation. The return's so low, you're actually losing money each year when you figure in inflation.
Right. And one of the things that a lot of guys like to do when they're talking about the problems with cash and CDs is to ask, you know, what's that paying? For example, what's cash paying these days? Or what can you get on a 2 or 3 year CD these days?
80 basis points or maybe 1% if you're lucky somewhere, you know.
Right. So let's just be generous and say that you're getting 1%. Rule of 72 says you take your interest rate divided by 72 and into 72, and that's how many years it takes to double your money. So if you had money in cash, how long, if it's paying 1%, how long would it take to double that money?
72 years.
Right. And when you're talking to a 60 or a 70-year-old, what do they start to realize?
They might not live that long.
That they won't. They know they won't live to be 140 or 130. So they know that's a bad investment. And so my point, guys, is this. We might be able to find all kinds of problems with annuities, and their friends and their advisor and their brother-in-law might be able to find all kinds of problems with annuities. But compared to cash, how do annuities start to look?
Pretty good.
Compared to preferred stock and bonds, how do annuities start to look?
Pretty good.
So even skeptical people who are looking for reasons not to do something are starting to say, it's not that it's perfect, but it's what?
It's better than the alternatives we've looked at.
Yeah, unless we're going to stick our head in the sand, which we really can't do because that would mean just leaving it in cash and waiting 72 or 110 years for our money to double. Unless we're going to do that, this looks like our best option. This is what we're going to do. And we don't need to look any further because we just looked at all the other things that we might be invested in, and we just found out that they're wanting even worse than the annuity. The annuity, sure, it has some drawbacks, but they're drawbacks that I can live with, and they're certainly better than the cash or the CDs or the high-yield bonds or the treasuries or the other kinds of things or the preferred stock that I could be in, because those are my alternatives for safe money. So guys, always frame your solution as the best of the alternatives. Don't ever just go in there with one thing and say, this is the thing you should be invested in. Go in there and say, here are the things you could be invested in, but let's look and see which of them makes the most sense for you. They all have good things, they all have bad things, but which of them makes the most sense for you? And even engineers will look at the options and say, for my safe money, that's my best bet. And here's the great thing. For somebody who's nitpicky and looks into every detail, they're nitpicky about cash and CDs, and they're nitpicky about bonds, and they're nitpicky about treasuries, and they're nitpicky about preferred stock. They're going to say, you know what, the annuity makes the most sense. That's how you bring on an engineer. Show him the options, and that get him to tell you, my preferred solution is the best option of all the things that are out there. Any questions on that before we move on to the topic for today? See, I'm getting the church bell ringing endorsement. So I'm guessing no questions.
The Lord is looking down at you, Jeff.
He's saying,
favorably.
The Lord is saying, you know what? I hadn't thought of it that way, but I think I should get an annuity.
Refer him to me. You're too busy, Jeff.
Okay. You know he has a lot of money.
Yeah, exactly.
Let's talk about titling. But before we talk about titling, because titling comes in the disclosure meeting, let's talk just in general about the disclosure meeting. There's a saying out there that says possession is 9/10 of the law. So what does that mean, possession is 9/10 of the law?
He who has it in their possession has a great benefit. You know what I mean? They're likely to keep it.
Right. I mean, if you've already got it, it's easier to keep than it is for someone to wrest it away from you. Possession is 9/10 of the law. So when we work with clients, they generally have an advisor who's holding their portfolio. And why is it important to get the other advisor out of the picture?
Because it's a lot easier for them to go back to their current guy with whatever questions or have him change things that we might just point out than have them break that relationship with their advisor.
Yeah, I mean, if possession is 9/10 of the law, then he's in a great position to block the sale. So you kind of alluded to it, Don. How would he go about blocking the sale? I mean, if you have a great presentation and you do a really good job, and let's not talk about, not necessarily our process, but generally what I find is that advisors will have a first meeting where they do a fact find, and then they'll either show them a better solution or they'll talk about some mistakes that are being made in their current portfolio. And if that's what they do, what can the other guy do if he doesn't want to lose that account?
Just correct the mistakes. Do whatever you've pointed out to the client that the client likes.
Or if you have a better solution, how would he go about salvaging the account or keep you from moving it if that was the case? You had something that they hadn't seen from him before.
Well, he could explain away why they hadn't seen it, depending upon the particulars of the relationship, and then say, that's a great idea. I think, where you are, my idea was a great idea, but this one is newer and has a lot of benefits. And you can still go ahead and salvage the situation because it's very tough for people to break long-standing personal relationships or business relationships.
Yep. In fact, some of you might have heard me talk about an example of an advisor that I work with who said that a client came back to him for an annual review, and the day before the annual review, they said, hey, we're coming in tomorrow, and just as part of our annual review, would you mind having the surrender value of the annuities that we have with you on hand just so we know what they are? And he said, sure, I'll make sure I have that information, but why would you need to know the surrender values, or why that particular question? And they said, well, we'll talk about it when we come in.
Mm-hmm. You know where that's
So they come in the next day, and they're going through it, and they said, we got to be honest. We went to another seminar, and the guy showed us this thing where we can get tax-free income out of this life insurance policy, and we really like it, and we're thinking about taking our annuity money and doing that. And he said, well, did he talk about the company or give you an illustration? And they said, yeah, he did. And he said, do you mind if I take a look at it? And they said, no, we don't mind if you look at it. And he looked at it and he said, you know what? Here's a couple things to consider. One, did he ask you about A? And two, did he ask you about B? But at the end of the day, I can do this for you here as well. And guess what they said? Oh, well, we didn't know you did life insurance, but no, we'd rather do it with you. I mean, if you can do this, then yeah, we'll do it with you. We just didn't know you did life insurance. So guys, what just happened to that other advisor?
Just knocked out.
Yeah. And he's sitting there thinking, man, they loved it. They're going to do it, and they are going to do it.
Just not with him.
Right. But he's also wondering, why aren't they calling me back? Why aren't they coming back in? I was sure that this was a done deal. So it's really important that we get that guy out of the picture because, quite frankly, if possession is 9/10 of the law, who has the advantage here?
Yeah, their advisor always.
Yeah, and is it a big advantage or a little advantage?
Big advantage.
Yeah, it's huge. So what can we do about it? How can we get him out of the picture? Well, the thing like I talked about that I often see guys do is they like to go through their portfolio, their existing portfolio, and show mistakes. But here's the thing that I would tell you guys, never underestimate people's willingness to forgive mistakes.
Mm-hmm.
Tiger Woods still has fans.
Mm-hmm.
Elliot Spitzer's still married. People will forgive a ton of mistakes. And like we talked about, mistakes can be easily fixed. And here's the thing. These are problems that the prospect can live with. Why would I say that? Why would I say they can live with those problems? Because they have been living with those problems for all this time. They might be paying too much in tax, but you know what? They've been paying too much in tax for a long time, and did it bother them? Did they not go on vacation? Did they not go out to eat? Did they not go out to movies? Did they not buy Christmas presents for their grandkids? They did. So would it be nice to save some money in tax? Yeah, but it's not a big deal. It hasn't hurt us in the past. Would we like to save some money in fees? Yeah, but it's not a big deal. It hasn't hurt us or kept us or held us back in the past. These are problems that they can live with. And again, it's easier to have him fix the mistakes. But keep in mind, they're problems that they can live with unless we do what? Convince them that they're problems that they what? Can't live with. You might thought that your tax problem was a problem that you couldn't live with, or you might have thought the fees that you're paying were a problem that you could live with, but really once you understand the magnitude of it, you're going to find out that you can't live with it, that it's a lot bigger and a lot more of a problem than you thought. But here's the problem with trying to magnify mistakes. There are really two problems. If we could magnify the mistakes and make them seem way worse than they even knew, why would they think we were doing that? And I think we may have lost Don. And so maybe we can try and get him back.
Okay.
But it's okay if you
there
can.
we go. There we go.
Yeah, someone muted me, I think, yeah.
We can try, and I don't know, did you hear the whole conversation, Don?
Yes, I did. I heard everything, yes. Yeah.
Why, if we tried to make the problem seem bigger than they were aware of, to try and make them feel like maybe we can't live with these problems, why might they think we're doing that? A lot of times clients will think we're Yeah, go ahead, Don.
For selfish reasons, they think we want to get that business, so
yeah.
We're trying to magnify it.
Yeah, they know that we're biased, that we have an interest in making a mountain out of a molehill. So that's what they're going to think. You're making a mountain out of a molehill because you want my business. You're biased. And if they ever think that, are they going to become a client?
Never.
No. Here's the other problem with trying to magnify mistakes, and I hear this from advisors a lot. What am I going to do? I mean, I can only save them $500 in a year in taxes. And this is a guy with $1 million. What's he going to think $500 a year in savings is?
He's going to think it's not a big deal.
Yeah. Or I can only show him $800 in fees that I can save him. And again, this is a guy with a portfolio of $1.5 million. And he comes in and he already kind of likes the guy. What's he going to think about an extra $800?
Not a big deal.
It's not a big deal. So the two problems with trying to magnify mistakes is, one, a lot of times we can't. There's not enough of, we can't magnify it enough for it to be a real problem. And even we know that, so we're afraid to even show it or afraid to even bring it up. And that's when I get calls saying, well, what am I going to do? I can only save him $800 in fees and $500 in taxes for a total of $1,300. He's not going to think that's a big deal. I'm dead in the water. Or if we can magnify it by a lot to make it something that they would feel is a big deal. If we could show them that we could save them $10,000 in fees and $5,000 in taxes, and yeah, $15,000, that's a lot to him. What are they going to think?
Have their current guy corrected.
They might, but they might also think $15,000. No way.
Be very
I
skeptical.
know if I was paying an extra $15,000. You must be exaggerating. You must be trying to get my business. I don't believe that. So, mistakes, if you can magnify them enough, but not too much, if you can walk that tightrope and you have the ability, sometimes that will work. But it doesn't work a lot because most times we can't magnify them enough, or they think we're biased, and if they ever think that, they're not going to work with us. The other thing we can do is show better solutions, but that's weak. Why is that weak?
Because, they can go back to their current guy if they really think they're a little better solutions. That's all.
Yeah,
Correct?
we don't have any solutions that he doesn't have.
No.
And if they like him and like you, it's just a lot easier, less hassle, less confrontation than to do it with who?
The guy they're currently with.
Yeah, I mean, we started out by saying possession is 9/10 of the law, so again, who has the huge advantage here?
Their current guy, no question.
Yeah. So we're back to the question, how do you get him out of the picture? Well, we know this. It would have to be something that even in small doses makes people angry. Because remember, we said the problem with showing mistakes is in the portfolio is we might not find a big enough mistake. So it has to be something that even in a small dose would make them angry. And we talked about the fact that, you know what, he can fix these things. They're tolerable. They're easily fixed. We don't have any solutions that he doesn't have, so he can go ahead and offer that as well. It not only has to be something that even in small doses makes people angry, it has to be something that isn't easily fixed. Because if it's easily fixed, who will they go back to fix it?
Current guy.
Yeah. Because why?
Because it's easier for them.
Yeah, less hassle, less confrontation. It's easier, so it has to be something that even in small doses makes people angry. Can't be something that's easily fixed. And lack of disclosure, the fact that he hid things or didn't tell things, is the only thing that meets that criteria and works all of the time. And let me give you an example of that. Let's say I open up a checkings and a savings account because I saw that there's free checking. And then one day I'm opening up my statement and I find out there's this $5 charge coming out of my checking. So what do I start to think?
Well, you call a bank and find out why, because it's free checking. Why should you be charged?
And when I call them up, I'm not nice about it, I'm mad. Because I feel like I was misled. You know, the $5 charge might be perfectly legitimate, but in my mind, free checking should mean what?
Free,
Zero
no
charges.
charge check.
I should never be charged anything. There shouldn't be anything on that statement. And the fact that there is means that, yeah, it's free if I have a certain balance, but now you're telling me that because I dropped $1 below that balance, then I have to pay a $5 charge. And I just made another deposit that made it above that balance, but you still charged me the $5. Hey, you didn't tell me that there was a minimum account minimum. And second of all, free should be free. $5 is not free. Now here's the thing, guys. Can I afford the $5?
Sure.
Is the $5 a big deal?
No.
No. But I'm still mad. Why?
Because they misled you. They didn't tell you.
Yeah, I feel like they misled me. I mean, I've done this. I've gone to a gym before and been talking to friends that work out there, and they tell me that their startup cost, their initial fee was lower than mine. And so I'm wondering, hey, I think I got ripped off. I've left gyms because of that. because I felt like they didn't tell me that I could get it for lower if I, signed this piece of paper or did this other thing. So I felt misled and I left. And we're all like that. We all have stories like that. So disclosure is the key to getting people to leave their current advisor, because if they found out that he hid even a small thing, do they get angry?
Yes.
And if they found out that he hid 4 or 5 things, do they get angry?
Much more so.
Much more so. And is that something that's easily fixed?
No. Not by
The
the
problem's
current guy.
fixed, but the fact that he hid it, that's not easily fixed. That's something that's a character flaw. That's a reason not to work with somebody, because does a zebra ever change its stripes?
No.
No, not in our mind. So the easiest thing to do in that case is leave. And so we want to use disclosure as the reason we give people to leave their current advisor. Not high fees, not poor titling, not tax savings, disclosure. We use all those things as excuses to have the disclosure conversation, but those aren't the reason they leave. Disclosure is the reason they leave, and we'll talk about that here in just a second. But every disclosure discussion follows a formula. It starts with the topic, whether it's titling or fees or risk or investment weighting. It's important because. Investment weighting. It's important to have a proper investment weighting because you don't want to take too much risk. It's important to have your accounts properly titled because you want to make sure that you have control of the account and that it goes to whoever you want if something happens to you. It's important to have your medical power of attorney electronically filed because you don't always carry it on your person. So it starts with, this is important because, and then that's what concerns me. What concerns me is you are going to have a problem because of your titling. You are going to have a problem because of your investment weighting. You are going to have a problem because of interest rates going up. And then consequences. Here's the problem you're going to have. And you should go through the consequences where they're answering your questions and telling you to the point where they're on the verge of asking, how do you fix that? Because if they're on the verge of asking, how do you fix that, then in their minds it's what?
It's important.
It's important, something that needs fixing. And then we always, always, always end with, why do you think this wasn't covered? Why do you think he didn't tell you this? Why do you think this wasn't done to begin with? So let me role play with Don kind of how you would do that in the context of titling. Remember, I'm not here to say that your titling is bad. I'm going to use the problem, or you have problems with your titling. I'm here to tell them that he hid things from you, and I'm going to use the fact that they have problems with their titling as an excuse to have that conversation. So if I was having a disclosure meeting, I might get to the part in the meeting, I'm just going to follow the template of the disclosure, the printed out disclosure, and I get to titling. And I'll say something like this. The next thing I want to cover with you, Don, is that your assets may not be titled correctly. So is it okay if we just take a minute to go through that?
Sure.
I see a couple of instances in your particular situation, but let me just give you one example. You have this brokerage account. And see your Merrill Lynch account here? It's titled in your name and your wife's name with joint with rights of survivorship. See right here where it says JTWROS?
Yes, I do see that. Yep.
Okay. Now, there are a lot of good reasons why the account would be set up that way, because if anything were to happen to you, what would happen to that account? Who would have control over it?
My wife. That's my assumption. Yeah.
Yeah, which is how you want it. And
That's correct.
it works vice versa. Let's say you were okay, but something happened to her. Then who would have control over the account?
I would.
Right. And again, that's what you would want to have happen. I mean, you're married. What's yours is hers, and what's hers is yours. So you want to make sure that if something happens to one or the other of you, that the other person is going to be okay, that they're still going to have access to the account, and they're still going to have control over it, and they're still going to have the flexibility that that money gives them. And that's exactly what you want to have happen. You want her to have control over the account if anything happens to you, and that's why you want her name on it. Now, you don't necessarily want your kid's name on it for obvious liability and creditor reasons, because let's say you had your kids on there and they got sued, and the attorney was looking and they saw their account, their name on that account. What might they go after as well?
They might go after my account.
Right, and that's why you don't put their name on it, but you want to make sure your wife is going to be okay if anything happens to you, so you want to make sure her name is on it, and that's why you have it that way. Does that make sense?
Makes absolute sense, yes.
So the fact that it's set up this way makes it easy to make sure that the account goes from one or the other of you if something were to happen. And it's automatic. You don't have to fill out any paperwork or jump through any hoops to make that happen. It just happens automatically. And that's why titling is so important, because it makes sure that we have control and flexibility over our accounts, and that it goes to whoever we want to have the money without having to jump through a lot of hoops, without having to fill out a ton of forms. It just does it how?
Automatically.
Right. And I guess that's what concerns me. Because we know what happens if something happens to you or something happens to your wife. But here's my question. How does the brokerage firm know who this account should go to if anything were to happen to both of you? Because only your name and your wife's name appear on the account. How would they know where it should go if you both were to pass away?
Well, I don't know if we filled out a beneficiary form of some type. I don't know. I assume we did.
And there are accounts that do have beneficiaries, but this particular type of brokerage account doesn't have a beneficiary.
Oh.
You can't put a beneficiary on this account. It doesn't come with beneficiary forms. It's just the way it's titled. So if only your name and your wife's name is on it, the brokerage wouldn't necessarily know where it should go. But let's think about this. Every state has a process for sorting out accounts just like this one, and you may have heard of it. It's called probate.
Oh, I've heard of it. Yes, I have.
And it's a legal process. Yeah, it involves a judge and a court. And here's the thing. Anytime you get the government or the courts involved, I mean, do they work fast or slow?
They work slow and then it costs money.
Yeah. So it would cost your kids. You would want it to go to your kids, and I'll tell you something. It probably would go to your kids because you have a will. And if your kids are in your will, the judge is going to see that when it goes through probate, and it's going to go to your kids. So your kids will get the money, but like we talked about, probate in the state of Connecticut, I mean, it doesn't happen overnight, right?
No, I dealt with my father's estate. It was almost 2 years, about 20 months.
But eventually, you got whatever accounts he intended for you to have. It's just that it took that 20 months, right?
Yeah, the time and the hassle.
Yeah. So it's time and it's hassle. And if you ever feel the need to kind of hire an attorney to kind of help navigate the process, not only is it going to cost time, but it's also going to cost what?
Money.
Yeah, because
attorneys,
they don't work for free, right?
No, they don't. No.
But if that's what has to happen, it is what it is. I mean, you don't want to add your kids' names to the account just so that they can get it right away because of the liability or creditor issues we talked about. So you leave it in your wife's name and your name, and eventually, after time and after money, your kids what?
They get the money.
Right. So there is hassle. There is cost. And here's the thing. Do we really want it to cost them time or money, or would we rather they just got it right away without the hassle and without the cost?
I'd rather they get it right away. I don't see why they should have to go through that.
Right. And do you think you're unusual in that way, or do you think most people would just want their kids to have the account when they were gone?
I would assume most people would want to have their kids have the account without the problems we talked about.
Yeah. And I always assume my clients don't want to go through probate unless they tell me specifically that they do, and I've never heard that. And, I mean, you didn't have a conversation with your advisor where you said you wanted these accounts to go through probate, did you?
Oh, absolutely not. Of course, I don't want them to go through probate.
Right. And again, that's kind of what concerns me, because this account is going to be forced unnecessarily through probate. And here's the
Why
thing.
unnecessarily? What can I do about it?
Well, here's the thing. Had you said to your advisor, I really don't want my kids to have to go through a lot of hassle or time or money to get this account if anything were to happen to us, is there a way for them to just get this money without that time and without that hassle? You know what he would have said? Sure there is.
What?
He would have just reached into his left-hand drawer, pulled out a piece of paper, asked you to put your kid's name down, sign it, and in 2-3 minutes, it's done.
Well, I mean, he should know. I mean, who wants to go through probate? I mean,
Right.
well,
It's just a matter of filling out a form.
mhm.
And so here's the thing. We'll help you to get that form and help you to make sure that it gets filled out correctly. But I guess my question is, if your broker knows about the form and it doesn't take any time to fill it out and do this, and it saves your kids a ton of hassle and a ton of money, why doesn't he just have you fill out that form to begin with?
God knows. I don't know. I would have assumed that he would have done that.
Right. Well, let's think about why it might not have happened just for a second. We said that it might take 6, 12, 20 months for the account to process through probate, and your kids don't have access to the account during that time, so who keeps that account in the meantime?
A broker and the brokerage firm.
Right. And why would they want to keep it, or why would it matter to them?
Well, they make money on it. Maybe they want to meet with the kids and persuade them to leave it there, but
Right, because they could tell the kids, don't worry about it. As soon as it passes through probate, whenever that is, we'll have a check waiting for you to go ahead and move this account. But probably, like you said, during that time, they're probably having conversations trying to convince the kids they should do what?
keep the account with Merrill Lynch.
Yeah, and why would they want them to do that?
Well, because they make money on it. It's for their benefit to do it that way.
Right. So why do you think they didn't have you fill it out to begin with? We'll never know.
Well,
If you had to guess,
No,
why
I
would you?
mean, I hate to think that it was done deliberately, but that they would benefit in a big way from it. It teased me off because I discussed probate with my guy. I like him. I don't find any problem with him, but I just don't well, as you say, they have a selfish interest in it. That could be a reason. I hate to think that. But
Yeah, and we don't know that it was done deliberately.
no.
It might just be a mistake. But it's interesting because the mistake is in whose favor?
Theirs.
Right. So, disclosure, that's the end of the role play, guys. Disclosure, remember, I could just say your accounts aren't titled correctly, and I could stop there, but that would be a mistake. A mistake that's easily what?
Fixed.
Fixed. And because it's easily fixed, where would they be tempted to fix it?
Current guy.
Yeah, their current guy. So we have to take that extra step of asking, why wasn't this done to begin with? And that's a little bit unfamiliar to us. And there's a right way and a wrong way to do it. The right way is to start slow. Don't go in with the machete. They'll be too defensive. Start slow. Introduce it slowly with power of attorney. Turn it up a little bit with titling and beneficiaries. And then go for the jugular on things with fees and risk and diversification, but start slow. More is better, because if they just did it once or twice, they'd be disappointed, right?
Yep.
But if they see it done 4 and 5 times, they start to see a pattern. And it's that pattern of non-disclosure that gets their blood boiling. So start slow, but more is better. Do it 4 or 5 times. We give you a list of 22 topics, and you don't have to go 22 for 22. But we're hoping in that 22 that you can at least make the point 5 or 6 out of the 22 times, because 5 or 6 times, by the end of the 6th time, they're thinking, wow, he's not telling us a lot. But they're only going to say that if you're always asking, why wasn't this shown to you? Have you seen this before? Why do you suppose you haven't seen this before? Have you heard this before? Why do you suppose it wasn't brought up? Always ask why. And the easiest way to do this is to use the disclosure software. It builds the case the right way. It puts everything in an order that starts it slow and builds it up. It gives you multiple topics, 22 topics, so that you have an opportunity in those 22 topics to make 5 or 6 really good points. And you always, always, with every topic, have to ask why. Otherwise, it's just a list of mistakes. And what could they do with the list of mistakes?
Go back to their current time.
Right. So make sure you're using disclosure to drive that wedge between the client and their current advisor, because that's what gets them to say, I don't know if I'm going to change investments, but for sure I'm going to change what?
My advisor.
Right, and once they change advisors, once they make the decision to change advisors, getting them to go forward and change the investments becomes a lot easier. So we're at the top of the hour. Any questions that anybody has?
Nothing has come in on the chat here at all, so I think we're pretty good.
All right. Well, again, guys, Mike will be back at the end of the week. If you have any questions, everybody here at the office, we're still open. We're still available. We're still here to help you with any questions that you have. And you don't have to wait for your monthly call to ask a question. We're always here for you. So if you need anything, give us a call. With that, we will let you guys go. Have a great week, and thanks, Don.
Thanks. Bye-bye.